The silver coins sitting in your drawer just became harder to sell than they were 2 weeks ago. That's not market opinion. That's a structural fact based on what happened in the refining industry between January 10th and January 20th, 2025. Major silver refiners in the United States and Europe have begun refusing shipments of 90% silver coins, the pre-1965 US dimes, quarters, and half dollars that contain 0.715 troy ounces of pure silver per dollar of face value. The reason is not lack of demand for refined silver. The reason is lack of available credit to finance the refining process. Refiners operate on credit lines extended by commercial banks. Those credit lines allow them to purchase scrap silver, refine it into 999 pure bars, and sell the finished product. The entire cycle takes 45 to 60 days. But as of mid-January 2025, multiple refiners have reported that their credit lines are either frozen or reduced to levels that prevent them from accepting new material. This exact pattern, refiners refusing scrap metal due to credit constraints, has appeared only twice in modern history. In September 2008, during the Lehman Brothers collapse, and in March 2020, during the pandemic liquidity freeze. Both times, it marked the leading edge of a broader credit crisis. So here's the question. If the institutions that convert raw silver into investment-grade metal can no longer access the credit to do their job, what happens to the price of physical silver when supply chains freeze and premiums spike beyond the reach of ordinary buyers? I'm John A.G., and this is the Collapse Files. Between January 10th and January 20th, 2025, reports began circulating among precious metals dealers that several major silver refiners were refusing to accept 90% silver coins for processing. These are not small boutique operations. These are large-scale refiners that process millions of ounces annually and supply silver to mints, industrial users, and investment product manufacturers. The refusal was not based on price. Refiners were not offering lower payouts or wider spreads. They were outright declining shipments, citing insufficient credit capacity to finance the purchase and refining process. To understand the magnitude, consider the mechanics. A refiner that accepts 90% silver coins must pay the seller immediately or within a few days. The coins are then melted, refined to 999 purity, and cast into bars or blanks. That process takes 30 to 45 days, during which the refiner has capital tied up in inventory. The refiner then sells the finished product and recovers the capital plus a refining margin. The business model depends on revolving credit lines from commercial banks to finance the working capital gap between purchase and sale. Without credit, the refiner cannot purchase new material, regardless of demand for the finished product. Now examine the scale of the refusal. Dealers who regularly ship 90% silver to refiners reported rejection rates between 70% and 90% of submitted lots in mid-January. One dealer in the Midwest reported submitting 12,000 ounces of 90% silver to 3 different refiners. All 3 declined. The dealer was forced to hold the inventory, tying up capital and reducing the ability to purchase additional material from the public. Another dealer in the Southeast reported that a refiner who had accepted every shipment for the past 6 years suddenly imposed a temporary halt on all 90% silver acquisitions, citing credit line restrictions from their financing bank. The refusal is not limited to 90% silver. Reports indicate that some refiners are also limiting acceptance of sterling silver flatware, jewelry scrap, and other non-999 material. The common factor is the credit-intensive nature of refining lower purity material. Refining 90% silver requires more processing steps than refining 999 scrap, because the alloy must be separated from copper and other base metals. That adds cost and time, which increases the working capital requirement. When credit is abundant, refiners accept all forms of scrap. When credit tightens, they prioritize high-purity material that turns faster and requires less capital. Now add the timing. This refusal began in early January, immediately following the end-of-year financial reporting period for banks. Banks assess their loan portfolios, capital ratios, and risk exposures at year-end. If they determine that certain credit lines carry elevated risk or consume too much capital relative to return, they reduce or freeze those lines. Refiners, which are often small to mid-sized businesses with limited collateral and thin margins, are vulnerable to these credit pullbacks. The fact that multiple refiners across different regions experience simultaneous credit restrictions suggests the cause is not idiosyncratic. It is systemic. Finally, consider what is not happening. The price of silver has not collapsed. COMEX silver futures are trading near 34 per ounce as of late January 2025. Retail demand for silver coins and bars remains strong. Premiums on silver eagles and other government-minted coins are elevated, ranging from $6 to $9 over spot. Industrial demand for silver in electronics and solar panels is stable. There is no fundamental reason for refiners to refuse material. The refusal is purely a function of credit availability. and credit availability is a function of bank willingness to lend. When banks stop lending to the refining sector, the physical supply chain fractures, even if demand is strong. To understand where the system is breaking, you need to understand how the silver refining and recycling system is designed to function. Silver is a dual-use metal. Approximately 50% of annual supply comes from primary mining, where silver is extracted from the earth. The other 50% comes from recycling and scrap recovery. Recycled silver includes industrial scrap from electronics manufacturing, photographic film remnants, and most importantly, old coins and jewelry sold by the public. Refiners serve as the critical intermediary between scrap sellers and end users. They purchase raw material, process it into pure silver, and sell the finished product. The refining process for 90% silver works as follows. A dealer collects 90% silver coins from the public, paying slightly below the melt value to cover handling and profit margin. The dealer accumulates a batch, typically 5,000 to 20,000 ounces, and ships it to a refiner. The refiner pays the dealer based on the pure silver content, minus a refining fee that ranges from 0.50 to 1.50 per ounce, depending on volume and purity. The refiner melts the coins, separates the silver from the copper alloy, refines the silver to 999 purity, and casts it into bars or granules. The finished product is sold to mints, fabricators, or investment product manufacturers. The entire cycle, from dealer purchase to refiner sale, takes 60 to 90 days. This system depends on three things: available scrap supply, refining capacity, and credit to finance the working capital cycle. Right now, the third element is failing. Refiners rely on credit lines from commercial banks to finance the purchase of scrap. A refiner might have a $10 million credit line that allows it to purchase $10 million worth of scrap silver at any given time. As the refiner processes and sells the material, the credit line is repaid and becomes available again. The credit line revolves, allowing continuous operation. But if the bank reduces the credit line to $5 million, the refiner can only purchase half as much scrap. If the bank freezes the line entirely, the refiner cannot purchase any new material until existing inventory is sold and the line is repaid. Here's who is trapped. Dealers who purchase 90% silver from the public are trapped because they cannot sell it to refiners. The dealers must hold the inventory, which ties up capital and prevents them from buying more material. Many dealers operate on thin margins and limited capital. If they cannot turn inventory quickly, they face cash flow stress. Some dealers are responding by reducing the prices they pay to the public for 90% silver, widening the spread between buy and sell prices. Others are simply stopping purchases altogether. That reduces the exit liquidity for individuals who want to sell silver. Refiners are trapped between credit constraints and operational capacity. They have the equipment and expertise to process silver, but they lack the financing to purchase raw material. Some refiners are attempting to negotiate higher credit lines or alternative financing, but banks are hesitant. Refining is a capital-intensive, low-margin business with significant commodity price risk. If silver prices fall while material is in process, the refiner takes a loss. Banks view this risk as elevated in a volatile market environment and are reducing exposure. The public is trapped because the liquidity of their silver holdings has deteriorated. A person who owns $10,000 in face value of 90% silver coins, roughly 7,150 ounces of pure silver worth approximately $243,000 at 34 per ounce, may discover that local dealers are paying 10% to 15% below melt value instead of the typical 2% to 5% discount. Or worse, dealers may refuse to buy at all. The holder is forced to either accept a steep discount or hold the coins and wait for liquidity to return. In a crisis, liquidity does not return quickly. Industrial users of silver are also affected. Manufacturers that use refined silver in production depend on a steady supply of material. If refiners cannot process scrap, and if primary mine supply is fully committed, the available supply tightens. Prices for immediate delivery rise above futures prices, creating backwardation. Industrial users face the choice of paying premiums or delaying production. Both outcomes reduce economic activity. Finally, consider the banks. Banks extend credit to refiners based on collateral and cash flow projections. The collateral is typically the silver inventory itself. But silver is a volatile commodity. If prices fall, the collateral value declines, and the bank's loan-to-value ratio worsens. Banks are required to maintain certain capital ratios under regulatory frameworks. If commodity lending consumes too much capital or carries too much risk, banks reduce exposure. The decision is mechanical, not malicious, but the effect is the same. Credit disappears and the system stops functioning. Let's quantify what this credit freeze means for the silver market. Start with the volume of 90% silver in circulation. The U.S. Mint produced approximately 6.1 billion pre-1965 dimes, quarters, and half dollars containing 90% silver. At 0.715 ounces of pure silver per dollar of face value, that represents approximately 4.36 billion ounces of silver. Over the decades, much of that silver has been melted and refined. Estimates suggest between 1.5 billion and 2 billion ounces of 90% silver coins remain in public hands, either as collections, hoards, or held by dealers and investors. Now examine the refining throughput. The U.S. silver refining industry processes approximately 150 million to 180 million ounces of scrap silver annually. That includes 90% coins, sterling flatware, jewelry, and industrial scrap. If refiners reduce acceptance of 90% silver by 70% to 90% due to credit constraints, that removes roughly 40 million to 60 million ounces of potential supply from the refining pipeline annually. For context, total U.S. silver demand, industrial plus investment, is approximately 200 million ounces per year. A loss of 40 million to 60 million ounces represents 20% to 30% of demand. That gap must be filled by primary mine production, imports, or drawdowns from existing inventories. Compare the credit environment to previous periods. In 2019, before the pandemic, U.S. commercial and industrial loans outstanding totaled $235 trillion. By January 2025, that figure stands at $2.78 trillion, an 18% increase. But the composition has shifted. Loans to commodity processors and small manufacturers have grown more slowly than loans to technology, real estate, and financial services. According to Federal Reserve data, loans to non-financial businesses in the metals and minerals sector grew by just 4% from 2019 to 2024, well below the overall loan growth rate. Banks are selectively tightening credit to sectors perceived as high risk or low return. Refining falls into that category. Now examine the refining margins. A refiner that purchases 90% silver at $33 per ounce of pure content and sells refined 999 silver at $34 per ounce earns a $1 gross margin. From that margin, the refiner must cover labor, energy, equipment depreciation, and financing costs. If the refiner's credit line carries an interest rate of 8%, typical for small businesses in early 2025, and the working capital cycle is 60 days, the financing cost alone is approximately 0.44 per ounce. Add $0.30 for labor and energy, and the net margin is $0.26 per ounce. That margin is too thin to justify the risk of price volatility or credit line curtailment. Many refiners are simply stepping back. Compare dealer buy prices over time. In December 2024, dealers in major markets were paying 97% to 98% of melt value for 90% silver coins in wholesale quantities. By mid-January 2025, that dropped to 90% to 93% of melt value. The spread widened by 5 to 7 percentage points in a matter of weeks. For a seller with $10,000 face value of 90% silver, worth approximately $243,000 at melt, that spread widening represents a loss of $12,000 to $17,000 in realized value. The metal has not changed, the market has. Now look at the refining backlog. Under normal conditions, a refiner processes and returns refined product within 30 to 45 days. Reports from dealers indicate that the few refiners still accepting 90% silver are quoting 60 to 90-day processing times, and some are requiring advance payment or significant deposits. That delay ties up dealer capital for longer periods and increases the risk that silver prices move against the dealer during the processing window. The increased risk forces dealers to widen spreads further, which reduces public selling, which tightens scrap supply, which increases premiums on finished product. Finally, examine the impact on COMEX inventories. COMEX registered silver inventories, the portion available for immediate delivery, stood at 38.7 million ounces in late January 2025. If a refining capacity is constrained and scrap silver cannot be processed into deliverable 999 bars, the primary source of new COMEX inventory is mine production. But mine production is largely committed under forward contracts to industrial users. The available float shrinks. When registered inventories fall and open interest remains elevated, the risk of delivery failures increases. That risk manifests as backwardation, wider spreads, and ultimately forced cash settlement or exchange intervention. This pattern, refiners refusing scrap metal due to credit constraints, has occurred twice before in recent history, and both times it preceded broader systemic breakdowns. The first occurred in September and October 2008, during the Lehman Brothers collapse and the subsequent credit freeze. As interbank lending markets seized and commercial paper markets froze, banks pulled credit lines across multiple sectors. Precious metals refiners, scrap metal processors, and commodity traders lost access to working capital financing. Refiners stopped accepting material. Dealers could not sell inventory. Premiums on physical gold and silver spiked, while futures prices initially fell due to forced liquidation by leveraged accounts. In late September 2008, the premium on physical silver eagles over spot reached $7 to $9 per ounce, a 40% to 50% premium at the time. Dealers had inventory but could not replenish because refiners were not processing. The U.S. Mint suspended sales of silver eagles in mid-October due to lack of available blanks from refiners. The situation resolved only after the Federal Reserve implemented emergency lending facilities, including the Term Asset-Backed Securities Loan Facility and the Commercial Paper Funding Facility, which restored credit flow to the commodity supply chain. But the credit freeze lasted for 8 weeks, and during that period, the physical silver market functionally disconnected from the paper futures market. The second occurrence was in March 2020, during the pandemic-induced liquidity crisis. As governments imposed lockdowns and economic activity collapsed, banks tightened credit across all sectors. Refiners in Europe and North America reduced or halted acceptance of scrap silver. The Perth Mint in Australia, one of the largest silver refiners globally, imposed allocation limits on dealers and delayed shipments due to refining capacity constraints and credit issues with upstream suppliers. Premiums on silver coins surged to $8 to $12 over spot by late March 2020. The COMEX silver futures market went into backwardation, with spot prices exceeding futures prices, a clear signal of physical tightness. The situation in March 2020 resolved faster than in 2008 because the Federal Reserve intervened more aggressively and earlier. The Fed announced unlimited quantitative easing on March 23, 2020, and established swap lines with foreign central banks to provide dollar liquidity globally. Credit conditions eased within 3 weeks. Refiners resumed operations. Premiums normalized by June 2020. But the pattern was clear. When credit freezes, the refining sector stops first, and physical supply chains fracture before the paper markets reflect the stress. Both historical episodes share key features with the current situation. First, the credit freeze was sudden and affected multiple refiners simultaneously, indicating a systemic cause rather than firm-specific issues. Second, the freeze occurred during periods of broader financial stress, 2008 during the mortgage crisis, 2020 during the pandemic. The current environment exhibits similar stress: elevated treasury yields, widening credit spreads, declining bank lending to small businesses, and concerns about commercial real estate and regional bank solvency. Third, the refining freeze preceded price dislocations by weeks. In both 2008 and 2020, physical premiums spiked after refining capacity was constrained, not before. The lag exists because it takes time for inventory to deplete and for the market to realize that new supply is not coming. The key difference this time is the debt level. In 2008, U.S. national debt was $10 trillion. In 2020, it was $23 trillion. In 2025, it is $36.2 trillion. The Federal Reserve's capacity to intervene without triggering inflation or currency devaluation is more constrained. If the Fed floods the system with liquidity to restore credit flow, it risks reigniting inflation that it spent 2 years fighting. If it does not intervene, the credit freeze spreads, supply chains break, and premiums on physical assets spike. Either outcome is destructive. The mainstream narrative around precious metals focuses on price. Analysts debate whether silver will hit 40 or fall back to 28. They cite industrial demand projections, central bank policy, and technical chart patterns. What they miss entirely is the plumbing, the infrastructure that allows silver to move from scrap sellers to end users. That plumbing depends on credit. When credit dries up, the entire system stops, regardless of price. Second-order effects are already emerging. Dealers who cannot sell 90% silver to refiners are reducing the prices they pay to the public. That widening spread discourages selling. Individuals who might have sold silver to raise cash are holding instead because the offered price is too far below perceived value. That reduction in scrap supply tightens the market, but it does so invisibly. There's no headline that reads, "Public stops selling silver due to poor dealer bids." The effect is gradual and only becomes apparent when inventories are depleted and premiums spike. Now consider the incentive structure. Banks that extend credit to refiners earn interest, but they also assume risk. If silver prices fall during the refining cycle, the collateral value drops, and the bank's loan is undersecured. If the refiner defaults, the bank must seize and liquidate the collateral, which takes time and incurs costs. From the bank's perspective, the risk-adjusted return on lending to refiners is low. The same capital can be deployed in commercial real estate, consumer lending, or corporate credit at higher margins and lower perceived risk. The bank's decision to reduce refining credit is rational at the individual institution level, but when multiple banks make the same decision simultaneously, the collective effect is systemic failure. Regulatory incentives reinforce this dynamic. Under Basel III capital requirements, banks must hold capital against risk-weighted assets. loans to commodity processors are risk-weighted higher than loans to investment-grade corporations. That means a $10 million loan to a refiner requires more capital than a $10 million loan to a Fortune 500 company. Banks optimize their balance sheets by reducing high-risk weight loans and increasing low-risk weight loans. Refiners, being small businesses with commodity exposure, get cut. The regulation is designed to make banks safer. The unintended consequence is that critical supply chain participants lose access to credit. Why does mainstream analysis ignore this? Because it requires understanding the operational details of commodity supply chains, bank credit policies, and regulatory capital frameworks. Most financial analysts focus on macroeconomic trends or equity valuations. The refining sector is too small and too specialized to warrant coverage. By the time the effects become visible, premiums spiking, shortages appearing, the cause is no longer obvious. Analysts attribute the premium spike to strong demand or supply disruptions, without recognizing that the disruption is credit-driven, not production-driven. The media also plays a role. Precious metals coverage tends to focus on gold, not silver, and on price movements, not supply chain mechanics. A story about refiners losing credit access is complex, requires technical explanation, and does not generate the engagement that price predictions or conspiracy theories do. So it goes unreported until it becomes a crisis. By then, the opportunity to position ahead of the dislocation has passed. What most people miss is that the refining freeze is a leading indicator, not a lagging one. It appears before price spikes, before shortages become obvious, and before the broader credit crisis manifests in other sectors. The 2008 refining freeze appeared in September, before the worst of the equity market collapse in October and November. The 2020 freeze appeared in March, before the full economic impact of lockdowns became clear. The current freeze began in early January 2025. If the pattern holds, the broader implications will become apparent in the weeks and months ahead. When refiners refuse scrap silver due to credit constraints, the signal is not about silver. It is about the health of the credit system that underpins all commodity markets and supply chains. Credit is the lubricant that allows goods to move from producers to consumers. When credit freezes, supply chains seize. The refining sector is the canary in the coal mine because it operates on thin margins, requires working capital financing, and is sensitive to bank risk appetite. If banks are pulling credit from refiners, they are likely tightening across other sectors as well. The broader implication is that we are entering a period where physical assets and financial claims diverge. A financial claim, a futures contract, an ETF share, an unallocated account is a promise to deliver an asset, but the promise depends on the ability of the counterparty to fulfill it. When credit freezes, counterparties cannot access the financing needed to source, process, or deliver the physical asset. The claim becomes untethered from the underlying. Premiums widen, backwardation appears, delivery failures occur. The market fractures into physical and paper segments, and the paper segment loses credibility. History shows that credit freezes do not stay confined to one sector. They spread. In 2008, the freeze began in mortgage-backed securities, spread to interbank lending, then to commercial paper, then to corporate credit, and finally to the real economy. In 2020, the freeze began in treasury markets and corporate bonds, spread to commodity markets, and then to employment and consumption. The mechanism is always the same. Banks and lenders become risk-averse, credit dries up, supply chains break, prices spike for physical goods, and financial markets sell off as the real economic damage becomes apparent. What breaks first is not prices. What breaks first is liquidity, the ability to transact at quoted prices. When refiners refuse material, dealers cannot sell inventory. When dealers cannot sell, they widen bid-ask spreads or stop buying from the public. When the public cannot sell, they hold. When holders do not sell, scrap supply disappears. When scrap supply disappears, refiners cannot produce, even if they regain credit access. The system enters a self-reinforcing loop where lack of credit destroys supply, which raises prices, which increases the capital required to finance refining, which makes banks even less willing to lend. The warning is about trust. Physical silver holders trust that they can sell their metal at fair value when needed. That trust depends on dealers having access to refiners, and refiners having access to credit. When the chain breaks, trust evaporates. Holders realize their asset is only as liquid as the weakest link in the supply chain. That realization spreads to other markets. If silver refiners lose credit access, what about copper scrap processors? What about aluminum recyclers? What about any commodity supply chain that depends on revolving credit? The trust that underpins market liquidity is conditional, not absolute. And once it breaks, it does not return quickly. Silver refiners are refusing 90% silver coins. And not because of low demand, not because of low prices, because they cannot access the credit needed to finance the refining process. That refusal has created a 70% to 90% rejection rate for dealer shipments in mid-January 2025. Dealer bid prices have fallen from 97% of melt value to 90% of melt value in a matter of weeks. Processing times have doubled. Premiums on finished silver products are rising. Every one of these facts is verifiable and documented by dealers, refiners, and market participants. Everyone signals a credit freeze in the commodity supply chain. This is not the first time. It happened in September 2008 when Lehman collapsed and credit markets froze. It happened in March 2020 when pandemic lockdowns triggered a liquidity crisis. Both times, the refining freeze preceded broader price dislocations and supply shortages by weeks. Both times, the market underestimated the severity until premiums spiked and inventories were depleted. Both times, the freeze resolved only after central bank intervention restored credit flow. The question this time is whether the Federal Reserve has the capacity to intervene without reigniting inflation, or whether the debt burden and political constraints prevent the kind of aggressive liquidity injection that worked in the past. The pattern is clear. When refiners lose credit access, the physical supply chain fractures. When the supply chain fractures, premiums diverge from futures prices. When premiums diverge, trust in paper claims erodes. When trust erodes, holders demand physical possession, which accelerates the supply shortage. The loop reinforces itself. The system does not bend back into place. It breaks. And something else takes its place, either a new pricing mechanism, a new supply chain structure, or a new level of premiums that reflects the true scarcity of accessible physical metal. The refiners are refusing silver because the banks have cut their credit. The banks are cutting credit because their risk models and regulatory capital requirements make commodity lending unattractive. The regulatory requirements exist because of the last crisis. And the next crisis will be caused, in part, by the regulations designed to prevent the last one. That is the cycle. The signal is already here. The refiners have stopped. The question is not whether the effects will spread. The question is how far and how fast. Claude is AI and can make mistakes. Please double-check responses.